Hello, this is John Smallwood, certified financial planner, senior wealth advisor at Smallwood Wealth Investment Management. We are continuing on the conversation of the wealth curve blueprint and the wealth curve scorecard. The wealth curve blueprint is really a great tool to understand where you are, to focus on the key components of your plan: income sources, savings rate, taxes, debt structures, real estate taxes, lifestyle, current assets, current liabilities, and future liabilities. And future liabilities, college planning, wedding planning, bar mitzvahs, bat mitzvahs, all these things are such an important part of the plan, and they seem to happen a heck of a lot faster than we ever think that we're going to have. I mean, I'm 50, I got a kid out of college. I've got two in college. I've got one, who's a freshman in high school. That happened really quick. It happened a lot faster than I thought it was. And when I started planning for myself, 22 years ago, 23 years ago, when I had the first child, we made some assumptions. And I say that to be funny, but you want your kid to go to the best school that they can go to. You want them to have the best opportunities that they can have. And, you look at it and you say, okay, currently for the best schools, whether they're private or public, the private institutions are $35,000, $40,000 at the time. And then you put an inflation rate to it and you expect that it should be in a range of a certain area. And then you realize that inflation was much higher than you thought it was, and the expenses are much higher if you didn't do anything along the way. And that's what we're, these things come. And what I find is that as I look at, there are certain things that are preventing things from happening in the future. And it's kind of, I joke that that your past or anybody's past is controlling their future. It's those past decisions that we've made that weren't fully thought through and that we're now paying for that are hurting my current situation. What we talk about is from a debt perspective, not talking about your home mortgage, but car loans and student loans and credit cards and interfamily loans and medical loans and 401k loans. When those things are used on a regular basis, the principal and the interest of those payments become higher than a certain amount. It's really hurting your lifestyle. It's hurting your savings rate. It's hurting the efficiency of your tax benefits. And it's something that I kind of look at a car payment as part of lifestyle. For most people, you're going to have some sort of car payment. You might pay cash for the car, but you need to accumulate the money back up. So you're putting money back into a savings account so that 2, 3, 4, 5 years from now, you have enough money to buy the new car, because the car that you bought today is a lot less valuable in the future. And the replacement of that car 3, 4, 5 years is usually a heck of a lot more money. So even if you pay cash for a car, you still need to accumulate money somewhere. And that's why you may be looking at it as savings rate, but if it's to replace an item in the future, that planned obsolescence, right? So, I'm putting money aside to buy a car that's really not savings. It's just basically, it's a planned expense. Or if I'm putting money aside for college, it's a planned expense, right? It's not long-term savings. Part of the savings rate that you have has to factor in the planned obsolescence and the technological change and all of those things. But the core is that if the debt is too high, the principal and interest is going to be too high as a percentage of your income. It's going to either reduce your savings rate, decrease your tax rate, and either maybe reduce your lifestyle so that it's not optimal. And what we want to do is we want to understand how much it is, where is it the best rate that we can possibly get. We recently worked with a person who had significant, student loans from college and income well below $100,000. And the loan rates were not great. And the payments were going to be, $1,400 a month. not a lot that you can do to get out of that. So by working with a couple of different areas, we were able to help that person refinance some of this debt, get fixed rate as opposed to variable rates, and lock it in for a longer time frame, and reduce the payments down by 800, down into the $800 range, freeing up $500-600 a month that can now go to build short-term savings and do other things. Not that you can get the person out of debt, but how do you make that debt bearable so that you can enjoy and live optimally currently? And that's really a very important part. So when you're building your blueprint and you're looking at the current debt structure, there's many ways to make that debt more optimal, to benefit, get greater tax benefits from it, to make it less onerous on your daily cash flow. Optimally, we all want to be out of debt. It makes great sense. There's good debt and bad debt, right? Good debt is typically considered tax deductible debt. Bad debt, credit card debts, etc., non-tax deductible. Student loan is not a bad debt. It's an investment in yourself. If you didn't have the student loan, you probably wouldn't be making as much money. So it's not a negative. It's just how do we deal with it so that it doesn't constantly keep us in a position where we can't accumulate money and we can't buy houses and live our lives and have kids. This is such an important thing, okay? And accumulate wealth. I mean, we can do all those things, but the focus of the conversation is on accumulating wealth. So let's build a blueprint. Let's look at your debt liability, if that's important to you. If it's part of your overall plan, it may not be. And understand, is that debt structure optimal? Are you getting the most benefits from having that debt? And is it the most efficient for your unique plan? Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.